Hi Akshay, thanks for having me on the podcast. I'm Shauraya Bhutani, the co-founder and partner at CapConnect Advisors, a boutique investment bank headquartered in Singapore and New Delhi.
So, you're an investment banker. Let's start by understanding what what does a career in investment banking entail? What attracted you towards it? Like a broad understanding of the space.
Yeah, absolutely. So I'll answer what attracted me to it, and it's probably not the typical answer, right? So growing up in Delhi, and always being exposed to, I guess, movies, etc. Look very cool, like investment bankers wearing suits, roaming around,
Was Pretty
making big
Woman
deals.
an inspiration? Richard Gere.
Yeah, it's Pretty Women's a bit ahead of or before my time. So
Before your
I,
time, right? Right,
but
right.
Wall Street definitely, I mean one of those, and some of the recent ones, Wolf of Wall Street, etc. But as a kid, you're of course quite impressionable, and you see this and you think, oh wow, so cool, right? But that's what you know at that age. So how it, what happened, I guess because of that, I chose to do a business major. One of the reasons I chose to do a business degree with a finance major, and then one thing led to another, and I started working in investment banking. So probably that was the spark, I would say. If I wasn't fascinated, I would probably not have taken the business degree and a finance major. But it's in uni when I started, learning more about the nuances, the expertise required. It kind of, I went deeper into it, and then I did a couple of internships in Singapore, which exposed me to the working life. And as I did it, I just, got more entrenched, and I just loved it in terms of what goes behind the scenes, right? And it's of course very different to what you see in movies, right? I mean, it's outside looking in, it's of course fascinating, etc. But when you're working inside, it's basically a knife fight in mud, right? But
Wow.
you should enjoy doing that, and it's not always pretty. It's ugly, but you should enjoy both sides, right? So as I started doing internships, got my first job on the investment side, not investment banking, but worked with some of the investment banks as our advisors. Got to know how they work, etc. So it just attracted me. Then I left the investment job and then joined a boutique investment bank, and then they say rest is history.
So the difference between investments and investment banks is in investments you are working with somebody who has money and helping them invest that money. And in investment banking, your clients are people who are either seeking money or looking to invest money.
That's right. So investments is typically, like a private equity or a venture capital fund or hedge fund, which have the money which they've raised, then they deploy it. So it's effectively the buy side, right? And in an investment bank, typically, especially on the corporate finance side, you're the advisor. So, like you said, you're advising companies who are trying to raise money or sell themselves, or buyers who are looking to acquire smaller companies. So you're effectively the intermediary in the transaction, and you're helping them.
And what are the different types of investment banks?
Wow. I mean, these days, I mean, there's a lot of investment banks floating around, but I'll try to break it down, right? So I'll start with the most known names, and they fit in the bulge bracket category. So, Goldman Sachs, JP Morgan, Morgan Stanley. Then you've got your mid market banks,
So
which
these
are,
Goldman Sachs and all would be like doing hundreds of millions of dollars of deals for
yeah, yeah.
large corporates.
Yes. So the difference between, I mean, I guess what bulge brackets do is they do larger deals, absolutely, but also they have more products to offer to their clients. So they would do corporate finance, which is effectively, advising on M&A, or advising on equity capital markets to raise capital, but that a boutique bank would also do in a smaller scale. The additions where the bulge bracket kicks in and offers more products and more departments is they have a sales and trading desk, for example. When hedge funds, etc., want to buy a certain security, they go through them. So they have access to these assets and to facilitate the buying and selling of these assets, whether it's equity or whether it's fixed income, right? So it's effectively corporate finance plus sales and trading, and some of the larger banks would also then include, corporate banking, where they themselves have a balance sheet and then they're lending to their clients. Although it doesn't fit in investment banking, but a lot of these firms have wealth management as well, where they're managing, larger family office money, high net worth individual money. So the typical advantage they have, that all of these interact with each other, right? They have access to capital, they have access to the best companies, and that's where the bulge brackets sit. At a smaller scale, also doing the same thing, some of the mid-market banks like Jeffries, HSBC to an extent. So it's bulge bracket, the mid-market banks, and then if you take out everything, if you strip off everything around sales and trading and wealth management, etc., then you have boutiques, right? Which are offering corporate finance services. And even within the boutiques, there are some of the more established boutiques which are competing with the bulge brackets on deals because of their experience set, and just because they're known, like Lazard and probably Julian Loki to an extent, which are competing with the bulge brackets on $1 billion plus deals. Then you've got within the boutiques, you've got regional or industry specific boutiques, which specialize, which is typically started by partners at ex partners from bulge brackets or ex partners from mid market banks who effectively wanted a larger share of the pie, right? They've built their relationships, they have expertise, and they're like, okay, we can go and do this ourselves, but we'll do it in a very niche and focused manner. But we're going to own more of the profits, right, rather than giving it to the shareholders of their previous companies. So these boutiques are offering, usually have very focused offerings, that we have expertise in this sector, we have expertise in this region. So then they can niche it out and then start competing as well with some of the larger mid-market banks.
Like for example, somebody helping tech startups in India to raise money, so that would be like a boutique investment bank.
Yes and no. I mean, a lot of the mid-market banks would also help tech startups raise. I guess the difference would be that if you're a smaller startup, then it's probably a boutique, like a seed Series A startup. Raising, say, anything between $1 million to $15 million, then that'd be
Okay.
a boutique. But if you're
Okay.
raising like 100, 200, 300 million, then the mid-market start kicking in, to an extent, right? And by region, the size differs as well. So, yeah.
Who are the major investment banks in India? And from a startup perspective, like if a startup was to raise that at seed round, whom would they go to? At a Series B, C, D round, whom would they go to?
Well, you should come to Capital Connect Advisors. I've heard that's a good form to bank. But in case we're busy, in in case we happen to be busy, no jokes apart, I think Avendis has done a great job, right? I mean, they were first out of
For
the
which
gate.
stage?
Across, I think, multi-stage. They started off. I think they started off about 20 years ago, focused on advising technology companies, and of course now have become this behemoth who offers like a lot of products. But vendors still remains a very good option for Indian technology founders, and they typically,
Like
I
even for
think
a
now
million
it's
dollars, you would go to a
yeah,
vendor.
no, not so. I mean, they started
Maybe
off
like
with doing
10,
smaller
15%.
raises.
Okay.
Yeah, they started off with doing with smaller raises. Now, of course, these it's the natural progression that now they do bigger deals. But if you're $1 million, if you're raising $1 million as a tech founder in India, there's a lot of options, right? I mean, there's also a lot of one-man bands, so to say, which are experienced ex-bankers, etc., which can connect you up. But these days, because the Indian ecosystem is so advanced, if you're raising $1 million, you typically would not need an advisor. If you have a solid product, solid value proposition, you can basically do without an advisor.
Um, what what's the cost benefit analysis if as a founder you were to look at whether to go with an advisor or not? There would be obviously some cost to it. What would that look like, and what would
Sure.
an advisor bring to the table as the
Yeah,
benefits?
absolutely, absolutely. So as a founder, to hire an advisor, I guess, I mean, the most scarce resource for a founder is his own time, right? And they're doing so much, hiring, building the strategy, working on the ops, doing BD, winning clients. So time becomes a very scarce resource. So an advisor should be hired if a founder has not, previously raised any funding, and does not have, say, a network into the VC or the early stage angel syndicate, etc. community. So a founder, advisor can come in and effectively, play that role. Although founders are expected to, do the pitching themselves, but all that goes behind in terms of, preparing the deck and preparing data, financial model, etc., can be done by an advisor. But equally, that can also be done by an experienced CFO, right? If you're raising a smaller round. So this I'm talking about if you're raising, say, less than $5 million. So I mean, then you should absolutely, do a cost benefit analysis of your time, and then hire an advisor or hire an experienced CFO to run the process.
And what does an advisor cost? It's a percentage of what you raise, or is it a fixed fee, or how does it work? Like,
Yeah, so typically, what we've seen, advisors in India for smaller raises, they take a percentage of the amount raised, and rarely, at least in the early stage, they also charge a retainer, which is offsettable against the success fee.
right,
So
the retainer
but
ensures skin in the game.
yeah, I mean, I think the retainer plays two things, right? I mean, especially as if you're a one-man band, smaller advisor, it helps with the working capital, because you're also committing your resources. And second, probably the more important part is that if I pay for something, I will value the services more and value their time more. So as an advisor, if you get a retainer from a founder, like founders like, shit, I've paid for this, now I've got to, I better commit.
Correct.
So yes, so
Absolutely.
retainer actually serves as a good tool for that as well.
Mm. And what does it cost typically? A ballpark percentage of, like, single digit percentage of what you
Yeah,
raise?
absolutely, absolutely. Anyone taking double digit, man, that's like you should run away, right? As a founder. So
Okay. Okay.
it starts again. It varies so much. Akshay, it's like, it varies so much. But I think typically you would see anything as low as 2% to 5% is the, in the middle, somewhere in the middle. But exceptional cases, of course, will vary. What we've seen, interestingly, some of the advisors do, which I think aligns the founder and the advisor quite a bit as well, is if you're an early stage founder raising money, instead of giving cash to the advisor, you do either a combination of cash and equity, right? So you take your fees as an advisor in cash, half in cash, say half in equity, right? So that commits you also, like, okay, we're here for the long term, right? We're not just here to
Right.
like take your cash and run away. And it helps founders because if as a early stage company, you need to preserve cash, right? You need to use cash for the right things. So as much as you can save, give equity. Equity starts becoming very expensive once you start growing. So early stage, you're okay to give some equity.
Okay. Very interesting. Okay. Okay. So tell me about your own journey now in the world of investment banking. So you finished your master's in business. Then what?
Yeah, so I did my master's in business with a major in finance out of Singapore Management University. And the reason, I guess, just a bit of context to come to Singapore again was because it's the financial hub of Asia, and of course, you can also work in the India market while being based out of Singapore. So I was very attracted. And my journey has been, I would say, I mean, everyone says their journey has not been typical, but I would say I would also say mine's not been typical, and that's for everyone else to judge. I finished my uni, joined an investment firm investing in renewable energy. Doing effectively investing in solar assets, wind farms in Southeast Asia, Singapore, Indonesia, Philippines, Thailand. Interned with them for a year before I joined. And effectively, last year of uni, all I was doing was interning. Right, I was like, okay, uni is done now. I need to get real experience. And yeah, I think at the cost of a bit of cost in my education, just to get real world education, I was interning for a year through and through. So worked with them for about a year and a half. Then joined after that. I joined a boutique investment bank in Singapore, and which was focusing on Singapore and Australia, effectively helping technology companies raise funds, but also M&A, right? Helping them sell themselves. So the focus was pretty much Singapore, Southeast Asia, and Australia. Um, I joined as the third employee with the firm, and worked with them for about 5 years. Also, it was a smaller organization, so you could, at least in Singapore, it was a smaller organization, so the upward mobility was quite high. The responsibility and ownership was quite high as well. But as long as you delivered on that, you could move quickly, right? So I joined as an analyst there, then left. Worked with them for 5 years, helped them build out the Singapore business, and then left. When I left, I was a director in the company, and me and my colleague who worked for the same company thought, man, I think it's time for us to do our own thing, right? I mean, we can drive our own strategy, and we feel confident enough that we'll be able to deliver more value to our founders if we have our own setup. So me and my colleague from the previous firm went and set up our own boutique investment bank called Capital Connect Advisors. And why we felt confident, Akshay, was I was 27 when I started that, right? And why I felt confident, of course, to have my co-founder with a certain set of experience, but also I think it's just from a risk perspective, when you're early on, you can take certain risks, right? And I always had this thing in my mind, although I knew that I had to get real world experience, do a job, is to do my own thing. So it was a very easy decision for me. Like it was, at least in my mind, it was like quickly, right? Um, so yeah, long story short, in 2021, we set up our own firm called Capital Connect Advisors, helping technology founders raise money and helping them sell their companies. Uh, Effectively focused out of Singapore, but a year ago, and I am Indian, but I am born and brought up in Delhi, but I hadn't worked one day in India. But I just couldn't ignore the opportunity, man. There was so much buzz going around, and I was like, I cannot sit in Singapore and be like, yeah, I'm only going to do like Southeast Asian deals, right? So a year ago, we expanded Capital Connect, set up a second office in Delhi, and to effectively serve the Indian market, serve the Indian founders. So now we have, of course, we're covering India and Southeast Asia, which is about 1.2 plus, 1.4 plus 2.1 billion people, right? So that's a massive market for us, emerging market, economy, etc. So yeah, now it's been 2.5 years. I'm proud to say it's been, it's only been 2.5 years, but I've aged, I think, about 5, 6 years, because it is not, it is a highly demanding job, but also very highly rewarding, especially when you're working for yourself, and you can see the results being, of course, to the rest of the people, but to yourself as well. Like it gives you a lot of satisfaction when you achieve certain things.
A couple of questions I want to zoom in on. So you spent about 5 years at Northridge, I believe, right? That was the
Yeah.
Singapore-based. What did you learn there?
Well, so much in 5 years, right? Because I was early on. So I have to say, in general, I've been lucky to now have had great people around me, right? My bosses, my mentors early on were very good, and just absorbing how they operate has been, education in itself. Now, what if I learned? I guess you can break it down from technical to soft, right? From a technical perspective, of course, honed into how to on the financial side, how to model companies, how to understand the drivers of the companies, how founders think about their growth strategy, etc., and then making it, listening to them, or getting their information and making it into something which is understandable by, say, the investor side, right? So it requires, it doesn't come instantly. It requires a lot of deals you got to work on, a lot of type of different sectors you got to work on. So just honing my technical skills, of course, right? That's the obvious one. Second, on the soft skill side, it's just I guess how to interact with investors, how to manage founders, what gets them going, how to position things. So that's more on the soft skill side. And I would say, I think when you're aged between say 20 to 25 in our industry, it's about honing your technical skills, because that should never be compromised. um, Even if you're a senior banker, you have to have all the answers. Like my I guess my framework, or like my principles, always been that don't I would not ask anyone junior to me to do something which I can't do myself, right? So honing your technical skills has become is very important from 20 to 25. But then really what kind of propels you forward is soft skills around people management, what drives people, but also driving insights about your sector. Like what do you can you call this first than any, like most of the other general public, so to say, right? And if you can call it first, then you can action it first, and you move faster. So it's a range of things. And of course, my time with Northridge, I learned a lot from a lot of great people, across technicals, across soft skills, also how to build a firm, right? Because even that firm was about 15, 20 people. They were building it out. How to do institutional building in general. So uh, yeah.
Technical skills means like working on presentation, crunching numbers, doing like a DCF valuation of businesses. That's what you mean by that.
Yeah, I mean, we don't now. I think it's come back, but actually, I don't think DCF valuation is
Right,
applicable
right.
in our sector.
Yeah, yeah, yeah.
But yeah, valuation in general, sure. Modeling companies on Excel, right? The basic, the grunt work, building presentations, information memorandums, teasers, building out the data room for a company. Effectively, the data room is what investors look at when they're doing their due diligence.
Okay,
um, so all of those things, right? I mean, it's
okay, okay.
yeah.
Uh, you spoke about taking a call about something which you think is going to happen before others reach that conclusion. Give me an example of what you mean by that.
Yeah, sure. So maybe I give you an example uh, from CapConnect's perspective, right? And where we've kind of seen and where we've been rewarded. So in terms of just the whole boutique investment banking business, it's quite crowded, right? There's a lot of people offering these services. But for us, it was even say the call to, as a Singapore-based investment bank, who's I think we're quite uh, we'd be quite good just doing business in Singapore, Indonesia, Vietnam, etc. But seeing that early on, the Southeast Asia market is very, very interesting, right? But if we want to expand, do say larger deals, we have to go and expand our market to India. Now what we have as our expertise set is, or network is, that we have investors based around the globe, looking at tech assets, and they want to be investing in emerging markets. But taking that call around, okay, we can offer them Southeast Asian assets, but the real actual scale comes from entering India, right? And sure, it's not really a noble idea that like no one saw it enter India, right? People have been doing stuff, but I would say today, I can make that statement and be 95% sure about it. In terms of a boutique investment bank focused on technology, the coverage we have is quite unrivaled, right? So no one in Singapore is sitting and thinking, okay, we should go out to India as well. And why should we go out? Um, the other thing, I guess, is just the switch to M&As, right? And I think we spoke about this before. The funding winter started hitting around 2022, or started kind of settling in, and it's still going on. And people were still focused on doing cap raises as advice. When I say people, I mean advisors, right? But when we were speaking to investors, we saw there's going to be a pullback, right? So we started kind of engaging our ecosystem more on the M&A side, because what we realized is that there's going to be a flight to quality in terms of where the capital is going, right? And a flight to quality in terms of not everyone's going to get funded. The top guys are going to, get funded, or at least have enough cash that once the valuations go down, they're going to go after, the M&A piece. Even the corporates are going to go after the M&A piece. So we started building the M&A case. Uh, I would think more early on than some of the other guys, and that served us quite well. Where we're currently running a range of M&As, which are going to be announced soon, and we're very proud that we did that early on rather than jumping late on the bandwagon. So these are small nuances. I'm sure I can think of other things, but that's what I have right now.
Right, right. Okay,
Yeah.
got it. Yeah. Tell me about what it takes to build an investment bank. Does it start by building a relationship with founders or with investors? Like, what comes first?
Well, it's a
I mean,
chicken
there's
and
like
egg.
a chicken and egg kind of a question.
It's a chicken and egg, and I just want to define the investment bank here. I, I think what I'm referring to when I say investment bank is a boutique investment banking shop which specializes in corporate finance, which is helping, primarily offering two or three products, right? Which is helping on M&A, effectively companies who want to sell or get acquired, helping companies with private placements who want to raise capital to grow, and three is strategic financial advice, which is, of course, embedded in the first two, but sometimes also as a standalone product. And this boutique investment bank, say ourselves, we're focusing on the mid market. Growth stage technology companies, Series B, C, D. So now I'll answer your question since I've defined it. I think it takes both, and also you have to, starting on, I guess you have to convince one side that you'll be able to do the job, and then take that side and then tell the other side that you have it, right? So it's like building blocks, right? So it's you build it slowly. It's not day one bang you can just go and be like, yo, I'm advising. I think it's the quality I found, to at least when you're starting on, is to be more flexible than some of the established players will be, to be even more optimistic, take the chances, and your chances of failure are high, but if you can succeed, then you've got this one basically brick now, and then you can lay another brick and lay another brick. So it gets built over time, especially as in your earlier career, or if you join like an already established uh, investment bank, then you're good, right? I mean, if today, even if someone joins us, they wouldn't need to do what me and my co-founder had to do before, because we've built that up. um, so it really varies. But if you're building from the ground up, even if you're building a career, like, forget like even an investment bank. If you're building a career in investment banking, you should be doing all of this as a early employee, right? Making the connections, etc., leveraging your firm's connection. So then your firm's connections eventually become your connections, because you've delivered value to them.
Okay, okay, got it, got it. You said that you have to take more risks when you're starting off. So risk here is because you get paid only if the fundraise happens. So there might be a company where another advisor may say no because he thinks they'll not be able to raise, but you would still
Yeah.
be a little more optimistic and work with them, and maybe some of those cases would work out, some of them would not work out. So that's what you mean by taking more risk.
E- One of the elements, yes, but it's also, I think, just an opportunity cost, right? Some of the companies are fixer uppers, in terms of, I mean, early on, right? This is in 2017, 16, when we were starting out. Fixer uppers in terms of there'll be a lot of work required, groundwork required before we can take them to market. Some of the established players are like, man, I don't have time to do this, or like, even if you do it, we don't. So that's when, like, I guess their extra work and the optimism has to kick in, right? That I can do the groundwork, prep them, and take them to market. It's so yeah. I mean, I think that's the main kind of risk, which is the opportunity cost and the closing risk.
Yeah, give me an example of a fixer upper, maybe you don't have to take a name, but hypothetically,
Yes.
what it would look like and what you would do for them to make them ready for a fundraise.
Yeah, absolutely. So if it's and this is I'm drawing from my experience very early on in my early days, right? So this is around 2016, 17, and I'll give you an example. So say a Series A company, which is got decent customers on board, but don't have, I guess, a full team built out, right? So the customers are built out only on the founders' capability. So effectively, the founders still the CEO, the COO, the chief business development officer, everything. Now he needs to get, if he wants to scale from say $1 million in revenue to $5 million in revenue, he needs to get a team in place, right? But before he gets a team in place, he needs to raise money to get it there. But how's he going to raise money if he's doing four jobs? So we come in, I guess, and be like, okay, out of the four jobs, you continue keep doing that. We'll at least take the CFO out, right? We'll go and fix your accounts. We'll fix your metrics. We'll go, get into everything and clean up your books effectively so you can present it in a way which makes sense. Then we'll go out to investors, do that, legwork, market you while you keep, because it's effectively you have to keep afloat while you're doing the fundraise, right? So once we fix the metrics, fix the accounts, put it in a nice presentation, put a data room, then we reach out to the investors, get him the money. But as a typical advisor, what would be, if you didn't have to do this, you'd go in, you'd have a CFO there, you'd have like a CEO there, and the work for us required, the work required on our side would be much lesser, right? We'll just go like, here are the investors. So we go and do all of these extra jobs, so the founder can be ready to raise money. And it pays off actually. Whenever we've done this, and sure, we haven't always been successful, but when we have been successful with these guys, they're like our clients for life, right? Or our friends for life even. So we've so many times we just been working for companies for like 4 or 5 years, because we did that extra stuff early on.
Hmm, interesting. Okay. Um, what is do you also take a retainer in such cases, or because you told me at early stage the retainer is par for the course? What about
Yes.
at the stage which you handle?
Yeah, actually, the early stage is not par for the course.
Okay.
In India, actually, no, rarely would you get a retainer. I have to say this.
Okay.
Like, I just want to
Okay.
clarify.
Okay.
Um, yes, so I just have to clarify that. Ourselves on our fee model, actually, if you're raising money, I can send you an engagement letter, and that will define everything. But yes, I mean, we typically work on our fee has multiple elements to it.
Okay, so like there would be some part of it which would come in as fixed, which could be adjusted. What you were saying, that adjusted against the success
Yes,
fees eventually,
yes.
or if it doesn't come through, then that money still remains with you.
Yes, yeah. I mean that's the retainer model. We've been quite innovative on our fee models. I wouldn't like go into details. It's not like a secret sauce or anything, but our founders are always, happy to pay us in terms of once we've defined the value we can deliver. So yeah.
Okay, okay, got it, got it. You spoke about providing strategic finance advice as a standalone piece, in addition to fundraise and M&A. What? Give me an example of that.
Yeah, sure. So if a company says in between fundraisers, right? Say between a Series B and Series C fundraise, and they don't want to go for a full raise, they want to say raise some debt. They want to raise some venture debt or any kind of debt, or even debt against their inventory for working capital, etc. So a lot of these guys are, I mean, typically are long-standing clients. So they'll come to us and be like, we're doing a small round of debt. Can you make some connections? And also, can you advise us on how you would structure it? So that's where I guess the strategic financial advice kicks in. Also, I guess on some of the, it's not very typical, but it happens when they're negotiating some customer contracts, which have certain provisions which might affect a future transaction, change of control provisions, etc. If you're affecting an M&A or planning to affect an M&A, So all of these things we'd advise on as well. Anything ancillary related to transactions, capital, it's effectively what we'd consider as strategic financial advice.
Okay, got it, got it. You spoke about building an M&A practice out once you realized that a funding winter was setting in.
Yeah.
What does that mean? Does it mean that you tell founders that okay, instead of a fundraise, why don't you be open to M&A as well, or like, do you also have to create some internal capabilities, or like, what does that mean to build that out?
Yeah. So I wouldn't say we build that out. I mean, we've always offered M&A services. I guess the switch was that how much we focus on M&A versus cap raise. So I would say before the tech winter, we were probably, about 70/30 focused on cap raise versus M&A. And now it's flipped, right? So it's about 70/30 now on M&A and cap raises. There is internally no specific capability to build out other than double down on your sectors in terms of where you've done deals and where your buyer network sits, because it's uh, M&As are very, of course, highly strategic. I'll give you an example, right? So if say um, Excel, which is the venture capital for firm, will fund probably 10 plus sectors, 15 plus subsectors, right, across say tech, health tech, fintech, e-commerce. But if you're an acquirer, you wouldn't. If you're running an M&A, your acquirer would probably fund two or three sectors basically. I mean, the universe reduces, so you have to be very specific. So I guess that you have to know where you have to know the sector you're focusing on, and you have to know where the appetite lies for your acquirers in that sector, right? So say in say a media sector, is it, are they focusing on buying more agencies? Is it programmatic ads? It's what is that? So it's based on that you pick up a target, or you pick up or a client specifically say, okay, we can, you know confidently say that there'll be enough interest, right? We can't guarantee the execution, but since we're in touch with potential corporate acquirers in the space or larger tech companies in the space, we know there's, appetite for a certain business model, a certain revenue scale, a certain, geography focus. So that's where you have to, I guess, sharpen up if you're, focusing or flipping on the M&A side. Because what you don't want to do as a smaller firm is take bets. You want to be, I mean, of course, there's always a risk of completion, but you try to reduce that risk by knowing what's happening in your sector and having those acquired contacts. That's actually, I guess, that was the flip. We started doing more of that, and that was the flip which we did.
How much of your business is driven by the people who have money, and how much is driven by people who are seeking money? Like, seeking money could be either looking to raise or looking to sell. So which
Got it.
side drives
So
business more?
sell side or buy side. So typically we do sell side.
Hmm.
I would say it's 70/30 as well, or probably 60/40, but
Okay.
more towards. So yeah, we typically would do sell side, and we. Uh,
And this is typical across all boutique investment banks, that sell side dominates,
yes, yes, I would think so. Yeah, I mean it's generalizing, but I can say that's yes, that's true.
because they need advice more because they are in need of money, so they're more willing to pay for advice and pay for connections
Exactly.
and pay for facilitation.
Yeah, and also more volumes, right? Just more of these guys seeking money. And some of the bigger guys, the acquirers, either have their own setups. They have a fully built out M&A team. Uh, they do work with advisors sometimes, like a lot of times, but they with the nuance that they would typically have their own M&A, a corp dev team inside. And if it's a large corporate, then they, have long-standing banking relationships, which some of the larger banks would serve rather than boutique banks.
Got it. Got it. Okay. So if you get a mandate from a business that wants to sell itself, this largely depends on the knowledge base inside the team over there, or do you also have other ways to find who are good buyers and reach out to them? Like, is it a very human-driven approach, or are there tools which kind of enable the process of discovery and outreach to potential buyers?
Well, it's a combination of both. you can't possibly know everyone, yourself. So we rely, we have our proprietary network of, not proprietary, but our own built out direct network of acquirers. Then we supplement that with our partner firms, which are based all around the world. We have partners in US, in Europe, in Japan. Um,
These would be other boutique investment firms, or not
typically,
like. Okay.
typically boutique banks or mid-market banks, who we've known for a while, who we trust, and have worked on deals before. So we would, rely on them to augment our already existing network. And some of them, there is always some left, which uh, you have to build a first connection. So as long as to a founder, and this is sort of founder selecting an advisor, right? As long as the advisor can demonstrate that they know 70-80% of your investor universe from a first degree or a second degree tight connection, I think that should suffice. Um, so I would also, I mean, just now advising founders' perspective, right? Um, I would, if I'm selecting a M&A advisor, I'd give them, if they ask for an exclusive mandate, I'd give them subject to them okay with some outside parties supplementing their network, whether it's advisors, whether it's the founder network, and they get paid a lower fee there. So this is just, advice to founders negotiating engagement letters. What, as a founder, I've found, founders has found, is you should not do is have six bankers running around, six different banks running around, and you're thinking, I'm going to play the diversification game and volumes game, whatever hits. Like, it's effectively throwing mud at the wall, right? Whatever sticks. But that actually is very counterproductive, because there's no one, driving a transaction strategy. No one is, managing a coordinated process. And so yeah, I'm not sure if that was your question, but I think that's just a very important point.
No, that's interesting advice. Uh, Tell me something. Is there a macro reason for why there is a funding winter? Is it
Well,
just that the Russia Ukraine conflict and stuff like that, or what are the macro reasons for?
I mean, Russia-Ukraine conflict, I think, of course, is one of it amplifies it. But Akshay, I guess, I mean, you probably know this more than me because you've seen more cycles. Is that there was just the craziness which was happening in like 2020, 21, especially after or during COVID, the overpromise of digitization. People were just, uh, you could not that could not have lasted, right? And sure, in retrospect, everyone's like, yeah, of course that would not have lasted, but sure, we live in retrospect. So I mean, one is this several reasons, right? So one is, of course, the COVID-19 boom, which the technology sector faced. Like, now everything is going to be digitized, etc. And like, in that, in the hope of a post COVID-19 world, that technology adoption is just going to go exponential. So it did, of course, help that, but there was a bit of overpromise there. Second was, because of COVID, there was a lot of subsidies, etc., which went out by the and everything. A lot of the things are driven by US, right? To subsidize the guys who, loss of income, etc. Um, and once COVID subsided, they like, okay, we did all these subsidies. Now who's going to pay for it, right? So they had to adjust the interest rates, and then the interest rate is actually the main thing here, right? Which makes the world go round. From the source of capital, say the endowment funds in the governments, etc. Now they're like, okay, we want a higher return, right? And then they go to their where they deploy money, the private equity firms, the venture capital firms. They're like, okay, we're not going to give you as much money now, or we're expecting higher returns, so money gets constrained. And that's, that coupled with the Russia Ukraine war, the crazy valuations which were going on, like super unsustainable, right? It had to come, and I think this is one of the best times, actually. Although I'm not like, I don't have a 20-year career. It is 8-9 year career. I feel like, this it's a very good time. to operate. And I don't want to be insensitive because a lot of the companies are dying down, etc. But I think in general, it's it's what's needed. Not companies dying, but this kind of rewriting of business fundamentals, so to speak, and everyone making sense finally, right? Making building from something which makes sense. So I actually quite enjoy this time.
So you're saying that anyone who survives this funding winter is sure to scale and grow big, because this there is a, like, you're forced to be more disciplined and so on.
Yeah. So not everyone who survives, I think everyone will face different challenges. It's not going to be funding winter; it's going to be something else. But you'll be more battle hardened, and you'll have a higher chance to survive. Of course, there's a survivor's bias. Whoever survives has survived. Uh, but there will also be casualties which probably didn't deserve it. Right? So I mean, I think we have to be aware of it. Not everything is black and white. I guess. I mean, there are companies who were relying on funding in 2023 or late 2022, and they didn't know, or they didn't plan, and it hit them suddenly. So those companies died out, and those some of them must have been great companies, great founders, good products, and that's why I guess just coming back. It's not just about being, I guess, a great founder, great product, but how you can navigate the times, right? So I would, what we recommend a lot of the companies who come to us for fundraising. This was to your, I didn't actually answer your previous question, was that do you advise on M&A? Absolutely. Like, whatever it takes to see the next day, definitely consider it, right? And um, it could be actually a hidden opportunity. Yeah.
Uh, as a founder, how do you decide how much you should raise? Is it dependent on what's the demand for? Like, is it dependent on investor demand, or are there like some rule of thumbs? Like,
Um, yeah, so it shouldn't be based on investor demand, I would say, at least as a starting point. Because then, I mean, you have to plan actually for your business, right? Not how much demand. So I guess the main thing here is the runway, right? You got to see how much money you need to survive for, especially if an early stage startup burning cash, right? This is not for growth stage startups looking for growth investments profitable. I'm talking about early stage startups. You have to survive, say, typically 18 months, 24 months. 24 months might be a larger amount and might force you to dilute a lot of your shareholding. So 18 months is recommended in a good market, but in this market, if you're getting money for 24 months, just grab it, right? But typically, we'd say 18 months of runway. And as a thumb rule, again, like, varies, but uh, not more than 20% dilution in terms of, between 15 to 25% is what's recommended. So you have to, of course, see your dilution as well. And then when you have a number in, when applying this number one and two factors, when you have a number in mind, then you go out to market and say we're raising this. Then that's when you see if there's demand or not. Yeah.
um, let me give you an example. So let's say someone is building a SaaS business, and they could also build it with $500,000. They could also build it with $2 million, because with $500,000 you'll probably go slower. You'll probably try and figure out some way of revenue coming in sooner. You'll not invest so much in, let's say, hiring product managers and so on and so forth, but you'll focus more on a basic tech being in place. So I mean, you could go either ways, right? Especially at early stage, because it's not like your burn is etched in stone. You can you're
Hmm.
yet to hire people to create your burn. So how do you decide at that stage that what should you that should you be ambitious and say I want to raise 2 million, or should you be conservative and raise 500,000 and go through the MVP approach?
Yeah, there are no easy answers here, right? And it's also so subjective to the sector you operate in. And maybe one way to think about is that, so versus saying raising 2 million versus 4 million, right? Know that 4 million comes at the cost of dilution. And do you really need to go that fast? And in some sectors, that's the answer, right? Because your competitors can close in and block you out. Um, so I guess there's a lot of nuances in terms of, go fast, go slow. No one can answer that for a founder because they know their business the best, and also they know, or probably we can't assume that they know, but you know, people around them know that this is the right pathway, given that we have experience in the sector. So it's very hard to answer. I guess you got to balance a lot of factors. For a SaaS company, as you said, right? I mean, that's very specific. You said SaaS company. Um, then I guess you just got to take stock of the competitive landscape. See, is there a product out already there which is being adopted by your ideal, typical customers? Then you need to go fast and block them out. If you think it's a new product where you can win, say, a few marquee clients, try it out. A lot of the SaaS companies have seen serving enterprises, especially, the first customer actually serves as a testing ground for them. So you actually need, if you're an MVP stage, seed stage, pre-seed stage company, you raise your $1 million to run your tech, your product, your ops, and then get that one customer first, right? Let them pay for. I mean, that's another thing. Let them pay for your product development and go from there, right? So there's again so many nuances there.
Right, right. And I believe at that stage, whether you raise a million or 2 million, you will end up diluting similar amount, right? Like you'll still end up diluting 20ish percentage. It's just that maybe you go to a different set of investors if you want to raise half a million versus if you want to raise 2 million.
Yeah, then you also got to then you've got to actually factor for appetite, right? If some actually, it serves you sometimes that you have no revenue in the company and you're doing like a pre-revenue raise, right? Because then it's all like your convincing powers and how which sector you're in, if it's hot or if it's, if there's investor demand. Then actually you have to like qualify investor demand, because you're right. Like, if I'm raising, if I'm a pre-seed company, pre-revenue company, raising the round, I can raise 1 million and raise 500K and make a case each way that this is the valuation of the company, right? So absolutely, in that case, then you have to see what the investor demand is if you have a good team. But I guess the pitfall there, which I found, is that sometimes, when you raise at a higher valuation early on, then that valuation is like, uh, it's you're stuck with that, right? In your future raises, you might not be able to. So I'll give you a very specific, like, not some, I wouldn't name the company, but I'll give you an example, right? So say company A raises $5 million, or say, raises $5 million at a 20 million seed, right? Uses that in 18 months, now it goes back to market, rise to raise 30. Now the market has changed because the multiples are different, but your VCs from the first round won't let you raise anything below 20, right? Or would at least not like it, and you'd be, forced to. But those multiples are not justifying it. So the investors who you want on board, they look at it and be like, "There's no way I'm going to invest it." You know, that valuation, your metrics don't support it. You got, funded your previous round 20 valuation actually does not mean anything to me because that was a different market, different valuation set. So adjusting back to reality becomes very tough for founders. So actually sometimes it's, you should, of course, protect your dilution, but don't go crazy with your valuation, because that's just a number at the end, right? Net is like, I mean, you got to still grow, you got to still raise more money, and you got to exit and get the cash. So I think to be very aware of these things.
Okay, interesting.